Hello everyone, I'm delighted to be here today to talk about recent developments in cryptocurrency regulation. Today's webinar is the first I'll be giving on crypto regulation, with particular reference to the crypto regulatory regime in Hong Kong and how it compares to crypto regulation in other jurisdictions. In today's webinar, I'll provide an overview of different approaches to crypto regulation and of recent developments in global cryptocurrency markets. I would just mention that while I will be talking about other jurisdictions, I'm not qualified to advise on their laws, and what I say is based on my understanding of their laws from publicly available sources. I'll then look at some of the concerns raised by international standard-setting bodies before transitioning to a discussion of the impact of the Financial Action Task Force, the FATF's revision of its standards on anti-money laundering, AML, and counter-terrorist financing, CFT, to apply to virtual assets and virtual asset service providers, VASPs. I'll also be taking a look at some of the initiatives that are being taken to regulate stablecoins, which of course have been in the news with the collapse of the Terra USD stablecoin. In terms of the approaches to regulating cryptocurrencies and activities relating to them since crypto first appeared on the scene, jurisdictions have generally developed their own individual approaches depending on whether they perceive cryptocurrency as involving unacceptable risk or opportunities for innovation. Some, such as China, have imposed severe restrictions on cryptocurrency and related activities. Others, such as Malta, Gibraltar, and Dubai, have created specific regulatory frameworks for cryptocurrency with the aim of establishing themselves as crypto hubs. Jurisdictions such as the US, the UK, Hong Kong, and Australia, on the other hand, have sought to regulate cryptocurrency where they fall within existing categories of regulated financial instruments, such as securities, commodities, or e-money. The downside of trying to regulate cryptocurrency under existing regulatory frameworks is that shoehorning these very diverse assets into categories of investments created many years ago for traditional investments has led to a lot of uncertainty as to how the regulations actually apply. A number of international bodies, including the International Monetary Fund, the IMF, have highlighted the need for greater international coordination to address regulatory gaps and, given the cross-border and cross-sectoral nature of crypto activities, minimize the potential for regulatory arbitrage. In relation to anti-money laundering and counter-terrorist financing, as I'll be discussing in today's webinar, the Financial Action Task Force, FATF, has imposed requirements for member jurisdictions to ensure that entities conducting financial activities involving cryptocurrency are subject to the same anti-money laundering and counter-financing of terrorism obligations as traditional financial institutions. This has resulted in jurisdictions, including Hong Kong, changing their laws to implement FATF's revised requirements. The Financial Stability Board has also sought to promote a coordinated approach to the regulation and supervision of so-called global stablecoins, widely adopted payment-related stablecoins with the potential to be used across multiple jurisdictions. A prime example was Meta, previously Facebook's proposed Diem, formerly Libra, stablecoin, which was intended as a globally available retail cryptocurrency. The plans were quashed, however, as financial regulators warned that they would not allow Meta to operate without the kind of strict regulation that applies to banks and payment companies. As I'll talk about later, the FSB issued a report in October 2020 setting out high-level recommendations for the regulation and supervision of global stablecoins, aimed at addressing the risks they pose to financial stability. As a result, a number of jurisdictions have recently adopted or proposed the adoption of regulation to cover stablecoins. Stablecoins have obviously also been in the spotlight recently in the aftermath of the collapse of the Terra USD algorithmic stablecoin, which sent shockwaves across the crypto space and triggered the current crypto winter. I'm going to look now at some of the recent developments in global cryptocurrency markets and cryptocurrency adoption. There are currently more than 20,000 cryptocurrencies with a total market cap of over $971 billion as at the 8th of September 2022, and the largest by far is Bitcoin, with a total market cap of over $367 billion, which is now more valuable than many publicly traded companies. Around 19 million Bitcoin are in circulation, and 24-hour trading volume is over $33 billion. Ethereum and Tether rank second and third, with a total market cap of $196 billion and $68 billion respectively. While it remains to be seen how the Terra and Luna debacle will affect cryptocurrency adoption generally, 2021 was significant in terms of crypto ownership. Almost half of crypto owners in the US, 44%, Latin America, 46%, and Asia Pacific, 45%, made their first purchase in 2021, according to Gemini's 2022 Global State of Crypto report, conducted between November 2021 and February 2022. The survey found that people owned cryptocurrencies for different reasons. In some developing countries, crypto was often seen as a hedge against inflation. Meanwhile, in developed countries, crypto was generally acquired as a means of portfolio diversification. In terms of geographical location, Brazil and Indonesia led the race in crypto adoption, with more than 2 in 5, 41% of the respondents in each country reporting owning crypto, compared to 17% in the developed world, with adoption rates of 20% in the US, 17% in Europe, and 18% in Australia. The adoption rate in Hong Kong was 24%. In addition to increased retail demand for crypto, 2021 to 2022 also witnessed substantial institutional interest in this emerging asset class, at least prior to the collapse of Luna. As the PwC's fourth annual Global Crypto Hedge Fund Report 2022 showed, despite the inherent volatility of crypto, the period saw an increasing number of traditional hedge funds invest in crypto and the creation of more specialist crypto funds. Of the traditional hedge funds surveyed before the market collapse, 38% were investing in crypto, compared to 21% in 2021. According to PwC's estimates, there are now more than 300 crypto hedge funds. High net worth individuals are the most common investor type in crypto hedge funds, followed by family offices and funds of funds. Total assets under management, AUM, of crypto hedge funds continued to rise during 2021, up 8% from 2020. It's interesting to note that crypto hedge funds also make use of DeFi platforms to earn yield via crypto staking, 46%, lending, 44%, and borrowing, 49%. With respect to fund and fund manager domiciles, the Cayman Islands continues to be the most popular location for crypto hedge funds to domicile, with the US and the UK being home to most crypto hedge fund managers. In a further indication that crypto is edging towards mainstream finance, an increasing number of financial institutions entered the space during 2021 to 22. In May 2021, DBS Private Bank launched Asia's first bank-backed cryptocurrency trust service, which allows its clients to invest, custodize, and manage their digital assets. Singapore-based DBS has been expanding its crypto offerings, which are currently restricted to institutional and accredited investors. Other large financial companies are also dipping their toes in the crypto water, such as State Street, which has been offering administration capabilities for funds investing in crypto since July 2021. Other traditional market players in the crypto arena include Goldman Sachs, which offered its first Bitcoin-backed loan in April 2022, and BlackRock, which linked its investment technology platform, Aladdin, with Coinbase in August 2022 to allow its institutional clients to trade Bitcoin. The emergence of cryptocurrency exchange-traded funds has been an interesting development. In October 2021, the first US-based cryptocurrency CME futures ETF launched, the ProShares Bitcoin Futures ETF, and began trading on the New York Stock Exchange. After only 2 days of trading, BITO's assets topped $1 billion, the fastest any ETF has reached that threshold. The US SEC has not approved any physical spot Bitcoin exchange-traded products citing concerns about Bitcoin's volatility and potential for fraud and manipulation in Bitcoin markets. In December 2021, Fidelity Investments launched a physical spot Bitcoin ETF that trades on the Toronto Stock Exchange, alongside several other spot Bitcoin ETFs launched in Canada in 2022. Some countries have been enthusiastic adopters of crypto. In September 2021, El Salvador became the first country in the world to adopt Bitcoin as legal tender, although the IMF has urged it to reverse the law, citing the risks Bitcoin poses to financial stability and consumer protection. In April 2022, the Central African Republic also declared Bitcoin an official currency. Other trends before this year's market collapse include substantial growth in decentralized finance, or DeFi, and the use of stablecoins. DeFi is an umbrella term for peer-to-peer financial services on public blockchains, mainly Ethereum. It aims to provide a global, open alternative to the traditional financial system. DeFi involves cryptocurrency-backed transactions which are executed automatically, and blockchain-based smart contracts which allow people to trade directly with each other without the need for intermediaries. By replacing traditional financial institutions and intermediary fees with public blockchains and open source software, anyone with internet access can lend, borrow, long, short, and earn interest at a lower cost. Another trend associated with DeFi is yield farming, essentially a reward scheme which allows holders to earn interest on cryptocurrencies in return for locking up their cryptocurrencies. Stablecoins have become an integral part of the crypto ecosystem as they've become increasingly prevalent, not only for trading and payments, but also in DeFi applications. Stablecoins are cryptocurrencies which purport to address the high volatility of traditional cryptocurrencies by linking the stablecoin's value to one or more assets, such as a fiat currency or precious metals. Other stablecoins are algorithmic stablecoins, which purport to maintain a stable value via protocols that increase or decrease the supply of stablecoins in response to changes in demand. To date, around 100 stablecoin projects have been launched, with a total market cap of $157 billion as of the 20th of May 2022. Although the stablecoin market is small compared to the larger cryptocurrency market, it witnessed a 3,000% growth since the start of 2020. In April 2022, stablecoins' market cap reached their highest level at $182 billion. The market plummeted, however, in May 2022 following the implosion of the largest algorithmic stablecoin, Terra USD. Tether and USD Coin are the most widely circulated stablecoins, representing over 70% of the total stablecoin market cap. Terra USD's market share plunged from 9% to less than 1% after the depegging. In 2021, stablecoins were the most traded of all cryptocurrencies. Central bank digital currencies, or CBDCs, are another major development which, if they come to fruition, may eliminate the need for stablecoins. A central bank digital currency is the digital form of a current country's fiat currency, which is issued and regulated by its central bank. According to the IMF, CBDCs have the potential to improve the efficiency and reduce the costs of payments and improve financial inclusion. According to the Bank for International Settlements, there were 4 live retail CBDCs and at least 29 pilot projects as of the 1st of July 2022. Another 72 central banks have communicated publicly about their CBDC work. More than 80% of central bankers are considering launching a CBDC or have already done so. The Bahamas was the first country to launch a digital version of its national currency, the Sand Dollar, in October 2020. The objectives of the Sand Dollar include more efficient payments, shorter settlement times, greater financial inclusion, reduced costs, and stronger controls of money laundering and other illicit activities. The other jurisdictions using retail CBDCs are the Eastern Caribbean, Nigeria, and Jamaica. China began exploring the potential for a CBDC in 2014. It became the first major economy to pilot a CBDC in April 2020 when it launched pilot programs in 4 cities. As of June 2022, pilot programs were in operation in 23 Chinese cities, including Beijing and Shanghai, making this the largest CBDC initiative in the world. China has adopted a 2-tier approach for its CBDC, with the central bank issuing digital yuan to a list of approved commercial banks which distribute them to the public. There were around 261 million digital yuan wallets registered with individuals and around 3.5 million wallets held by companies as of February 2022. In the US, President Joe Biden issued an executive order on ensuring responsible development of digital assets in March 2022, initiating a comprehensive approach to cryptocurrency regulation and oversight aimed at striking what they deem to be the right balance between the opportunities and risks cryptocurrencies present. The executive orders urgent research into the benefits and risks of a digital US dollar, that is, a US CBDC, including an evaluation of the benefits and risks for consumers, investors and businesses, financial stability and systemic risk, national security and financial inclusion, and the actions required for issuing a US CBDC if it is considered to be in the national interest. The chairman of the Board of Governors of the Federal Reserve System is to report on the potential for a US CBDC to improve financial efficiency and reduce the costs of payment systems, and will examine the optimal protocol for a US CBDC. The cryptocurrency market is known for its ups and downs, but the recent market rout is unprecedented in its magnitude. During the first half of 2022, the crypto market cap fell to $890 billion US, down by more than 2/3 from a peak of $3.2 trillion US in November 2021. The price of Bitcoin, the largest cryptocurrency, dropped more than 70% over the same period, hitting levels not seen since 2017 and wiping out years of gains for crypto holders. This has resulted in many warning of a prolonged bear market, dubbed a crypto winter. The crash started with steady declines in crypto prices due to macroeconomic forces, including high inflation, which resulted in the US Federal Reserve and other central banks hiking interest rates. Then in May 2022, the largest algorithmic stablecoin, Terra USD, lost its dollar peg, which led to the collapse of Terra USD and its sister token Luna. Their demise had knock-on effects for companies exposed to them, including Three Arrows Capital, one of the world's largest crypto hedge funds, which had a significant exposure to Luna and suffered heavy losses on its collapse. Three Arrows Capital started to miss margin calls from the companies funding its trades in June 2022 and failed to repay a loan of $350 million US in USDC, the US dollar pegged stablecoin, and 15,250 Bitcoin. It declared bankruptcy on the 1st of July 2022. The collapse of Three Arrows, in turn, had a knock-on effect on the many crypto lenders which had lent to Three Arrows, loans which the hedge fund was unable to repay following the broader market collapse. Crypto lenders Celsius and Babel Finance paused withdrawals in June 2022, citing extreme market conditions. Celsius offered double-digit yields to customers who deposited their cryptocurrencies and lent those deposits to major crypto market makers and hedge funds, as well as to DeFi projects. As crypto prices plummeted in 2022, Celsius was hit by withdrawals and filed for bankruptcy protection in July 2022. A factor in the latest crash was that crypto investors had accumulated large amounts of leverage due to the emergence of centralized lending schemes and DeFi. In the second quarter of 2022, crypto funds and crypto lending platforms were forced to sell crypto when they couldn't meet margin calls. The leverage that resulted in the forced selling had been provided to crypto funds and lending platforms by retail depositors who invested for yield. These retail depositors were then left exposed. Unlike the traditional banking system, which normally ensures customer deposits there are no consumer protections for customers who deposit cryptocurrencies with crypto lenders. Cryptocurrencies transferred to the platforms are treated as unsecured loans. Another crypto lending platform offering high yields to crypto depositors is Voyager Digital, which also filed for bankruptcy protection in July 2022. The failure of these companies has shone a light on risky business practices, such as the high yields offered by crypto lenders to onboard depositors. It also exposed the web of debts that connected many of the industry's top players. Turning now to some of the statements made by international regulatory bodies and the areas they have identified for possible future regulation. The IMF has stressed the need for more international coordination to address regulatory gaps and prevent the potential for regulatory arbitrage, given the cross-border and cross-sectoral nature of crypto activities. In January 2022, the IMF published Global Financial Stability Notes on crypto connections, spillovers between crypto and equity markets, highlighting the rapid development of crypto assets and their risks. The IMF noted that as crypto interlinkages with the regulated financial system are growing, the absence of regulation in this area could cause risk to financial stability in many countries. As a result, there's a need to develop global standards that more fully address risks to the financial system from crypto assets without inhibiting the healthy growth of the industry. The IMF proposed in 2021 that the Financial Stability Board should establish a global network comprising standards for regulating crypto assets, with the objective of providing a comprehensive and coordinated approach to managing risks to financial stability that can be applied across jurisdictions, reducing the potential for regulatory arbitrage. It also noted that some emerging markets and developing countries are facing more immediate risks of sovereign currency substitution by crypto assets, which may require them to adjust their capital flow management measures to maintain the dominance of their sovereign currency. In February 2022, the Financial Stability Board released an assessment of risks to financial stability from crypto assets, which noted that despite their tremendous growth, crypto assets remain a small portion of the broader global financial system. Direct connections between crypto assets and traditional financial markets are growing rapidly, but remain limited, while the effects of price volatility have been largely confined to the crypto markets and have not spilled over to traditional financial markets. Nevertheless, the fast-evolving nature of crypto asset markets means that they may come to represent a threat to global financial stability due to their scale, structural vulnerabilities, and increasing interconnection with traditional financial markets. The assessment discusses developments and associated risks relating to three aspects of crypto asset markets: unbacked crypto assets such as Bitcoin, stable coins, and DeFi and crypto exchanges. It notes that these areas need to be considered holistically, given their increasing interconnectedness. In relation to DeFi, the FSB noted that its technology and centralized nature presents challenges to regulators. Since DeFi platforms aim to adopt a decentralized governance structure through the issue of governance tokens, it can be difficult for regulators to identify an entity or individual to make responsible for meeting regulatory obligations. Noting that the current generation of DeFi platforms are not truly decentralized, it comments that if they were, DeFi developers' typical claims of no responsibility would mean that responsibility would rest with the platform's entire user base. The global nature of DeFi platforms can also mean that the applicable legal jurisdiction covering their operations is often unclear. A further problem is that DeFi platforms do not necessarily insist on verifying the identities of counterparties, and that some third-party service providers offer privacy enhancement techniques to DeFi users. As regards stablecoins, the FSB commented that while they aim to maintain a stable value, price stability is by no means guaranteed and depends on how they are pegged and the nature of reserve assets. It noted that the composition and amount of reserve assets backing stablecoins can vary significantly, and that there are no standards for the composition of reserve assets backing stablecoins. Stablecoin holders may also have no direct right against the issuer or reserve to redeem, and there is no consistency in the disclosure practices of stablecoin issuers. The FSB also noted that the current generation of stablecoins are not yet used as a widespread means of payment. Rather, their most frequent use cases currently include acting as a bridge between traditional fiat currencies and various cryptocurrencies, facilitating lending and borrowing, and acting as collateral on DeFi platforms, and serving as collateral in crypto derivative transactions. The FSB warned, however, that if a major stablecoin were to crash, it's possible that liquidity within the wider crypto ecosystem could become constrained, disrupting the normal functioning of the market. Its impact could then spill over into short-term funding markets if stablecoin reserve assets were liquidated in a disorderly manner. The FSB expressed concerns about the future emergence of global stablecoins and the greater risks they pose to financial stability. It's worth noting that in October 2020, the FSB had issued a report on the regulation of global stablecoins with 10 high-level recommendations for the regulation of global stablecoins aimed at addressing the risks they pose to financial stability. In its 2022 risk assessment, it noted that a global stablecoin which entered the mainstream financial system as a store of value or means of payment could result in a disorderly run in the event of a loss of confidence in the stablecoin, which could disrupt the real economy and spill over into the traditional financial system. In July 2022, the FSB published a further statement on international regulation and supervision of crypto asset activities, noting that the recent turmoil in cryptocurrency markets had highlighted cryptocurrencies' inherent volatility and structural vulnerabilities and their increasing connection with the traditional financial system. The statement notes that crypto assets and markets must be subject to effective regulation and oversight commensurate with the risks they pose, both at the domestic and international level, and that an effective regulatory framework needs to ensure that cryptocurrency activities posing risks similar to traditional financial activities are subject to the same regulatory outcomes. The statement also calls for robust regulation of stablecoins that enter the mainstream financial system and are widely used as a means of payment and/or store of value in multiple jurisdictions, since these could pose significant risks to financial stability. It stressed the need for high standards on transparency and the maintenance of reserves that preserve the value of stablecoins. The FSB will report to the G20 finance ministers and central bank conveners in October 2022 on regulatory approaches to stablecoins and other cryptocurrencies. The FSB will submit to that meeting a public consultation report assessing its 2020 high-level recommendations for the regulation, supervision and oversight of global stablecoin arrangements. It will also submit a report proposing recommendations for promoting international consistency of regulatory approaches to other cryptocurrencies and crypto markets and fostering international cooperation and coordination. In December 2021, the Bank for International Settlements issued a paper called DeFi Risks and the Decentralization Illusion. The BIS argued that although DeFi is purported to be a new form of intermediation which operates through new protocols on blockchain and stablecoins, its decentralization is an illusion for two reasons. First, centralized governance is needed for making strategic and operational decisions. Second, there's always a tendency for blockchain consensus mechanisms to favor a concentration of power. The BIS notes that while DeFi has the potential to complement traditional financial activities, it currently has few real economy uses and largely acts to support speculation and arbitrage across different crypto assets. The paper adds that if DeFi were to become widely adopted, it would need to be properly regulated, and public authorities would need to address DeFi's governance structures to ensure that measures are in place to maintain financial stability and protect investors' interests. In July 2022, the BIS Committee on Payments and Market Infrastructures and the International Organization of Securities Commissions, IOSCO, published final guidance confirming that the principles for financial market infrastructures are applicable to systemically important stablecoin arrangements that transfer stablecoins. The PFMI are international standards developed by the CPMI and IOSCO to strengthen the stability of financial market infrastructures, i.e. payment systems, securities settlement systems, and so on. The guidance extends the international standards for payment, clearing and settlement systems to cover systemically important stablecoin arrangements. In determining whether a stablecoin arrangement is systemically important, national regulators have to conduct a holistic assessment of each arrangement, taking into account its size, risk profile, interconnectedness, and sustainability. Legal entities that are integral to systemically important stablecoin arrangements are required to maintain appropriate governance mechanisms, including those which enable timely human intervention and allocate ultimate responsibility and accountability to natural persons. In March 2022, the OECD issued a public consultation document on the Crypto Asset Reporting Framework and amendments to the Common Reporting Standard, proposing a new global tax transparency framework for crypto assets. The OECD pointed out that crypto transactions lack visibility, increasing the difficulty of verifying whether associated tax liabilities are properly reported and assessed. The new initiative seeks to increase transparency for global tax authorities by requiring VASPs to better identify users and report certain transactions. The proposed framework will subject intermediaries already providing crypto exchange services between crypto and other types of crypto or fiat currencies, including exchanges, brokers and dealers and ATM operators, to the reporting requirements within 12 months of the effective date of the rules. The public consultation period ended in April 2022. The OECD was seeking views on which crypto assets should be covered by the proposal. The proposed definition of relevant crypto assets, that is, crypto assets that give rise to reporting, would include stablecoins, tokenized derivatives, and certain non-fungible tokens. Apart from tax reporting rules, the OECD also proposes due diligence procedures to identify crypto users and the relevant tax jurisdictions for reporting purposes. Moving on to how cryptocurrencies are regulated. Regulators have generally been slow to regulate this space. This is despite a number of concerns related to the risks associated with cryptocurrencies and the general perception of the potential for the distributed ledger technology underlying cryptocurrencies and cryptocurrencies themselves to deliver significant benefits. Part of the difficulty facing regulators is the speed of evolution in cryptocurrencies and their use cases, which is driven by factors as diverse as customer preference, regulation, competition, developments in technology, speculation and privacy, and security concerns. For example, Bitcoin, the first ever cryptocurrency, was launched in January 2009 as an alternative means of payment, but has since evolved into a store of value, hedging, and speculative investment tool. Regulation needs to be considered in the light of the risks associated with cryptocurrencies, risks which I will briefly outline. Firstly, fraud. Widespread fraud was a major factor in China imposing a ban on ICOs in September 2017. In the US alone, more than $1 billion in crypto was lost to scams between January 2021 and March. Secondly, there is the risk of financial crime, the risk of cryptocurrencies being used for money laundering and terrorist financing. Thirdly, security and security breaches are a key concern. Cyber attacks resulting in crypto intermediaries being hacked and cryptocurrencies being stolen are common. $1.9 billion was stolen in hacks of various services, particularly of DeFi protocols, in the first 7 months of 2022. In 2021, more than $600 million was stolen in what is likely to be one of the biggest cryptocurrency thefts ever. Hackers exploited a vulnerability in Poly Network, a platform that connects different blockchains so that they can work together. In a strange turn of events, hackers returned half of the funds they stole. Cryptocurrencies also bear the risk of mis-selling and other market abuse activities, such as pump and dump schemes, although of course these are not limited to the crypto market. And finally, volatility. On the other hand, cryptocurrencies offer significant benefits. Virtual assets which act as a means of exchange, for example, Bitcoin, can provide more efficient and cheaper transactions, for example, in international transfers. And as originally conceived by Satoshi, Bitcoin was intended as a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution, according to Bitcoin's 2008 white paper. Published during the 2008 global financial crisis, Bitcoin's white paper offered an alternative to the traditional banking sector and financial access for the world's unbanked populations. The World Bank's latest 2021 Global Findex database found that 29% of the world's adult population does not have a bank or financial services account. Bitcoin was therefore envisaged as a means of providing a cheap and fast payment mechanism which could operate cross-border with far greater efficiency than was possible through traditional banks, while eliminating the possible risk of a failure of the financial system. Satoshi did not, however, foresee that Bitcoin would become a store of value or investment which people would buy for speculative purposes rather than its use value. The different uses of virtual assets and the fact that their actual use can be very different from the use intended by their creator are among the factors making the regulation of virtual assets so challenging. The most significant regulatory development to date comes from FATF, the setter of international standards on anti-money laundering and counter-terrorist financing. In 2018, FATF revised its recommendations, the global standards on AML and CFT. Recommendation 15 was revised to explicitly require member countries, which include Hong Kong, to regulate virtual asset service providers or VASPs for AML and CFT purposes. License or register VASPs and subject VASPs to effective systems for monitoring and supervision. FATF also issued an interpretive note to Recommendation 15, clarifying the amendments. Member countries need to subject VASPs to the full range of AML and CFT obligations that apply to traditional financial institutions under the FATF recommendations, including customer due diligence, record keeping, suspicious transaction reporting, and screening transactions for compliance with targeted financial sanctions. FATF also allows member countries to prohibit virtual asset activities and VASPs based on their assessment of the risks, or to support other policy goals such as consumer protection and monetary policy. FATF also revised the so-called travel rule in Recommendation 16 to require VASPs to obtain, hold, and transmit information relating to the originator and beneficiary when transferring virtual assets. The revision extends to virtual asset transfers the requirements that already apply to wire transfers. The travel rule is a key AML-CFT measure since it allows financial institutions and VASPs to conduct sanctions screening and detect and report suspicious transactions. The FATF requirement for the licensing or registration of VASPs has led to the adoption of new licensing or registration regimes across jurisdictions. However, the FATF requires that only that they are subjected to the same AML and CFT obligations as traditional financial institutions. As I'll be discussing in Webinar 3, a new licensing regime for VASPs is due to come into effect in Hong Kong on the 1st of March 2023 under amendments to the Anti-Money Laundering and Counter-Terrorist Financing Ordinance, that's the AMLO, which are currently going through Hong Kong's legislative approval process. FATF defines a virtual asset as a digital representation of value that can be digitally traded or transferred and can be used for payment or investment purposes. The definition explicitly excludes digital representations of fiat currencies, securities, and other financial assets that are already covered elsewhere in the FATF's recommendations. FATF defines virtual asset service providers as any natural or legal person who are not covered elsewhere in the recommendations and conduct any of certain activities or operations as a business for or on behalf of another natural or legal person. These activities are exchanges, virtual assets and fiat currencies, exchanges, different forms of virtual assets, transfers virtual assets, that's conducting a transaction that moves a virtual asset from one virtual asset address to or account to another. Fourthly, provides safekeeping and or administration of virtual assets or instruments, enabling control over virtual assets, and takes part in and provides financial services related to an issuer's offer and or sale of a virtual asset. VASPs therefore include cryptocurrency exchanges, providers of certain types of crypto wallets, and providers of financial services for ICOs. In October 2021, the FATF updated its guidance on virtual assets and VASPs, providing additional guidance on the definition of virtual assets and VASPs, how the FATF standards apply to stablecoins, countering ML or TF risks for peer-to-peer transactions, and the licensing and registration of VASPs, and the implementation of the travel rule and information sharing and cooperation amongst VASP supervisors. The updated guidance noted first that creators, owners, operators, or other persons who maintain control or sufficient influence in DeFi arrangements may fall within the definition of a VASP, where they provide or actively facilitate VASP services. This is the case even if the arrangements appear to be decentralized or portions of the process are automated. Owners and operators can be identified by reference to certain non-exhaustive factors: whether the person has control or sufficient influence over assets or other aspects of the services protocol, whether there's an ongoing business relationship between the person and users, even if this is executed through a smart contract or voting protocols, and whether the person makes profits from the service. FATF therefore recommends that regulators should not automatically accept claims of decentralization, but should rely on their own due diligence. Where it has not been possible to identify a legal or natural person with control or sufficient influence over a DeFi arrangement, FATF notes that countries may consider requiring a regulated VASP to be involved in DeFi arrangements to mitigate risks. However, as FATF standards do not apply to underlying software or technology, developers who create software or protocols for decentralized platforms will not be subject to AML-CFT obligations. Likewise, the FATF will not extend AML-CFT obligations which apply to intermediaries to individuals who engage in peer-to-peer transactions for the time being. Peer-to-peer transactions are defined as virtual asset transfers that don't involve a VASP or another obliged entity, for example, transfers between two unhosted wallets. The update recommends that countries monitor the MLTF risks relating to peer-to-peer transactions, and if they consider the risks to be high, to consider adopting various optional measures such as requiring VASPs to allow transactions only to or from addresses or sources that they consider acceptable based on their risk-based assessment. Requiring VASPs to allow transactions only to or from VASPs and other obliged entities, and or adopting additional AML-CFT requirements such as enhanced record keeping for those that allow transactions to or from non-obliged entities, and exercising enhanced regulatory authority over VASPs that allows customers to conduct transactions with unhosted wallets. The FATF doesn't want to see a digital asset that is intended for investment or payment purposes being categorized as both a financial asset, for example a security, and a virtual asset. It notes that it is the responsibility of each jurisdiction to determine if a digital asset is a financial asset or a virtual asset. Jurisdictions should assess which of their regulatory frameworks is most suitable for particular digital assets, taking into account which framework best mitigates the risk of the particular product. Jurisdictions should adopt a technology-neutral approach. a financial asset that uses blockchain technology should not automatically fall within the FATF definition of virtual asset. With the exception of financial institutions which only manage the reserve fund, all entities that issue, offer and maintain the reserve of stablecoins and those that distribute and trade stablecoins, including exchanges and custodians, may be subject to AML-CFT requirements. Central governance bodies of stablecoins will generally be covered by FATF standards, either as a financial institution or a VASP. These bodies are therefore required to conduct MLTF risk assessments before launching the stablecoin. Where there's a larger degree of decentralization, the FATF expects countries to adopt a functional approach to identifying obliged entities and mitigating relevant risks both before the launch of the stablecoin and on an ongoing basis after launch. NFTs, non-fungible tokens, and other digital assets that are unique, non-interchangeable, and generally used as collectibles rather than as payment or investment instruments generally fall outside the FATF definition of virtual asset. However, whether a self-proclaimed NFT is a virtual asset will depend on its characteristics. If a NFT can be used for payment or investment purposes, it may be considered a virtual asset. FATF does not regard central bank digital currencies as virtual assets since they are digital representations of fiat currencies. However, the FATF standards apply to CBDCs in the same way as they apply to other forms of fiat currency issued by a central bank. There is updated guidance which explains how to determine which countries VASPs should be licensed or registered in. A VASP should be licensed or registered at least in the jurisdiction in which it is created. References to the creation of a legal entity include the incorporation of a company or any other mechanism used to formalize the existence of a legal entity, such as registration in a register of companies or legal entities. Jurisdictions can also require VASPs that offer products or services to customers in their jurisdiction or conduct operations from their jurisdiction to be licensed or registered. In relation to VASP supervision, the guidance also makes clear that only competent authorities and not self-regulatory bodies can supervise VASPs. Turning now to one of the most controversial provisions, the travel rule, as set out in FATF Recommendation 16. The updated guidance provides more details as to how VASPs can comply with the travel rule on virtual asset transfers, including what data an originator and beneficiary VASP must verify for accuracy, what records they must keep, and the carrying out of sanctions screening on customer names. In the June 2019 guidance, virtual asset transfers between VASPs and non-obliged entities, for example unhosted wallets, were not subject to the travel rule requirements. The updated guidance now requires transactions with non-obliged entities to be subject to the travel rule. VASPs are now required to determine whether a transaction involves a VASP or an unhosted wallet and must apply the relevant measures. For virtual asset transfers to or from unhosted wallets, the obliged entity has to comply with the requirements set out in Recommendation 16 in relation to the customer, the originator or the beneficiary. The obliged entity is not required to submit the required information to non-obliged entities. However, obliged entities have to put in place mechanisms to ensure there is effective scrutiny of these transfers to satisfy broader transaction monitoring, suspicious transaction reporting, and sanctions implementation obligations. VASPs are required to collect data on unhosted wallets and related peer-to-peer transactions. They have to assess whether the transaction is within their risk appetite and determine the appropriate risk-based controls to impose on the transaction or customer. VASPs can impose additional controls or limitations on transactions with unhosted wallets. As I briefly touched on earlier, money laundering and terrorist financing is a risk associated with cryptocurrencies, and understanding the trends in the use of virtual assets for these purposes is important to better understanding and effectively tackling these challenges. So what do we know about the trends in MLTF in relation to virtual assets? Well, the FATF has observed that the value of virtual assets involved in most money laundering terrorist financing cases detected to date remains relatively small compared to cases involving more traditional financial services and products. In most detected cases, generally, only one type of virtual asset was used. Where more than one type of virtual asset was used, this typically involved the layering of illicit proceeds. Among the offences involving virtual assets, the most prevalent offences were narcotics-related and fraud offences. What about the risk landscape? Well, the FATF has observed that the dominant trends in the virtual asset money laundering or terrorist financing risk landscape include the use of VASPs registered or operating in jurisdictions that lack effective AML/CTF regulation. Illicit actors are exploiting poor customer due diligence and screening processes within these VASPs for ML and TF purposes. Another trend is the continued use of tools and methods to increase the anonymity of virtual asset transfers. These include a broad range of techniques, including registering internet domains through proxies and the use of tumblers, mixers, privacy coins, and privacy wallets. All these trends make it more difficult to track and trace the transaction trail. FATF issued a report back in June 2020 analysing the AML/CFT issues relating to stablecoins. The report said there were concerns relating to the potential for the mass adoption of globally available stablecoins. One of FATF's main concerns was that mass adoption could lead to a substantial increase in the number of anonymous peer-to-peer virtual asset transactions occurring via unhosted wallets, since peer-to-peer transactions that don't involve a VASP or other AML/CFT obliged entity are not explicitly covered by the FATF recommendations and can potentially be used to avoid the AML/CFT controls. FATF noted, however, that there are various options to mitigate the risks presented by anonymous peer-to-peer transactions if national regulators are concerned that ML/TF risks posed are unacceptably high. These include refusing to license platforms that allow unhosted wallet transfers, introducing transactional or volume limits on peer-to-peer transactions, or mandating that transactions involve a VASP or financial institution. So how do the FATF recommendations apply to stablecoins? The FATF examined 5 of the largest stablecoins to gain an understanding of whether or not the FATF recommendations sufficiently cover stablecoins. From its assessment, the FATF concluded that its recommendations do sufficiently apply to entities involved in stablecoin arrangements to mitigate ML and TF risks, as reiterated in the October 2021 guidance. The June 2020 report noted that entities within stablecoin arrangements will have AML/CFT obligations under the FATF recommendations if they meet the definition of a financial institution or a VASP, as set out in Recommendation 15. Where central governance bodies exist within a stablecoin arrangement, they'll generally be obliged entities under the FATF recommendations in the same way as other entities in the stablecoin arrangements, such as exchanges, transfer service providers, and custodial wallet providers. Discussions regarding stablecoin regulation started when Meta, then Facebook, announced plans to launch Libra, which became Diem, the globally available cryptocurrency for retail payment, back in 2019. And as I mentioned earlier, the FSB issued a report in October 2020 setting out high-level recommendations for the regulation and supervision of global stablecoins aimed at addressing the risks they pose to financial stability. The 10 recommendations set out in the report focus on privately issued global stablecoins intended for retail use. Looking at some of the key recommendations, first, regulatory authorities are expected to regulate global stablecoin arrangements proportionately to their risks. GSC arrangements should be required to have effective risk management frameworks in place in relation to reserve management, operational resilience, and AML and CFT measures. They should also be required to provide users with the information necessary to understand the stablecoin's stabilization mechanism and provide legal clarity on the nature and enforceability of any redemption rights and the redemption process. As I mentioned earlier, a number of jurisdictions have recently adopted or proposed the adoption of stablecoins, which I'll outline. In Hong Kong, the Hong Kong Monetary Authority published a discussion paper in January 2022 seeking feedback on its proposed regulation of payment-related stablecoins, being those crypto assets most likely to become widely accepted as a means of payment and thus most likely to intersect with mainstream finance. The HKMA is proposing a risk-based approach which will initially focus on activities relating to payment-related stablecoins. The regulatory emphasis will be on asset-linked stablecoins, such as those whose value is linked to a specific fiat currency rather than algorithm-based stablecoins. The HKMA proposes that certain activities relating to stablecoins will require authorization and licensing by the HKMA. The HKMA is proposing that any entity wanting to conduct any of the regulated stablecoin-related activities in Hong Kong will need to be incorporated in Hong Kong. The proposed regulated activities include, amongst other things, issuing or destroying stablecoins, managing the reserve assets backing the value of stablecoins to stabilize their value, executing transactions in stablecoins, and storing the private keys providing access to stablecoins. This would require expanding the scope of existing legislation, for example, the PSS-VFO, or enacting new law. Since stablecoin arrangements usually involve more than one entity, multiple entities in a stablecoin arrangement may need to seek HKMA authorization and licensing. The HKMA expects that the proposed regime's rules and requirements would take relevant aspects of Hong Kong's current approach to stored value facilities and payment regulation as a minimum to avoid regulatory arbitrage. Under a risk-based approach, the HKMA considers that stablecoin issuers should be required to be subject to higher prudential requirements to protect users. Japan became one of the first major economies to introduce a regulatory framework for stablecoins when it amended its Payment Services Act in June 2022. The revised law recognizes the legal status of stablecoins. To manage financial risks and bolster investor protection, the issue of stablecoins will be restricted to banks, trust companies, and certain licensed fund transfer agents, which essentially bars crypto startups from issuing stablecoins. The law defines stablecoins as digital currencies. Stablecoins will have to be linked to the yen and have a guaranteed right to redemption at face value. Brokers trading and managing stablecoins will need to be registered with Japan's Financial Services Agency and apply more stringent AML measures. However, the law does not address existing asset-linked stablecoins from overseas issuers like Tether or algorithmic stablecoins. The new regime will be implemented in 2023, with the FSA expected to issue further regulations for stablecoin issuers in the second half of 2022. In the US, the President's Working Group on Financial Markets and two other bodies issued a report on stablecoins in November 2021, recommending that Congress enact legislation to ensure that stablecoin payments are subject to a federal prudential framework. The report recommends that stablecoin issuers should be insured depository institutions regulated at both the depository institution level and the holding company level. The report also recommends subjecting wallet providers to federal oversight. Any entity that carries on activities central to the functioning of payment stablecoins would be subject to appropriate risk management standards. In the UK, a new regulatory regime for digital settlement assets is expected to come into effect in early 2023 with the enactment of the Financial Services and Markets Bill, which was introduced to the House of Commons and given its first reading on the 20th of July 2022. Digital settlement assets will be defined as a digital representation of value or rights, whether or not cryptographically secured, that can be used for the settlement of payment obligations, can be transferred, stored, or traded electronically, and uses technology supporting the recording or storage of data, which can include distributed ledger technology. Although the bill does not use the term stablecoin, it's expected that the UK government will use the definition to implement its plans to regulate stablecoins used as a means of payment as set out in HM Treasury's April 2022 response to its consultation on the UK regulatory approach to crypto assets, stablecoins, and distributed ledger technology in financial markets. The bill will also empower the Treasury to modify the definition of digital settlement asset, which will enable it to extend the scope of regulation to include crypto assets which are used for investment purposes. The Treasury will be given broad powers to create a regulatory regime for digital settlement assets under the bill. The powers granted to the Treasury will enable it to amend legislation to regulate payments involving digital settlement assets and payment systems involving arrangements using digital settlement assets, as well as their service providers. It will also be able to introduce insolvency arrangements for payment systems involving arrangements using digital settlement assets. In addition, the Treasury will be given powers to apply existing legislation regulating electronic money and payments to digital settlement assets. Under amendments to the Financial Services Banking Reform Act 2013, the Treasury may designate a payment system using digital settlement assets as a regulated payment system, which will be subject to the oversight of the payment systems regulator. Since stablecoins and other crypto assets may fall outside the UK's electronic money regime, it's thought that the Treasury may use its powers to establish a Financial Conduct Authority authorisation and supervision regime for digital settlement assets based on the UK's current electronic money and payments regulation. Given the systemic risk some stablecoin arrangements may present, Part 5 of the Banking Act 2009 will be expanded to cover payment systems using digital settlement assets and DSA service providers, including firms providing services to a payment system chain, such as custodians, issuers, and exchanges. The Treasury will be able to specify a DSA payment system or service provider as a recognised entity if it is likely to threaten the stability of or confidence in the UK financial system or have serious consequences for business or other interests throughout the UK. These entities will be regulated by the Bank of England, which will have the power to issue codes of practice, give directions, and pursue enforcement action. The Treasury will additionally be able to bring digital settlement assets within the Financial Market Infrastructure Special Administration regime, which allows a payment system administrator to carry on its service in the event of failure, even where this is not in the best interests of creditors. The EU Council made an announcement on the 30th of June 2022 that it had reached a provisional agreement with the European Parliament on the markets and crypto asset regulation, which proposes a comprehensive regulatory regime for crypto assets and service providers applicable across EU member states. While the agreed text has not yet been published, the EU has said that this will implement a strong framework for stablecoins aimed at protecting investors and preserving financial stability. The requirements that will apply to stablecoins include an obligation to maintain a sufficiently liquid reserve with a 1-to-1 ratio and be partly in the form of deposits. Stablecoin issuers will need to have a presence in the EU and provide redemption rights to holders. Stablecoin reserves are also to be protected in the event of insolvency. Stablecoins with more than 10 million users or reserves of more than 5 billion euros will be supervised by the European Banking Authority. Some commentators have said that stablecoins will be subject to a transactions cap of 200 per day. So that brings us more or less to the end of this webinar. Thank you again for joining me today. As I mentioned earlier, this is the first webinar I'm giving on crypto regulation. The next will focus on Hong Kong's regulatory regime for crypto. You're most welcome to join us. You can find the link to register on our website, charltonslaw.com. Thank you and bye.